Hello everyone, welcome to the Tim Booker channel, and enjoy listening to the book. The book you interpret in this issue is Snowball, Buffett and His Wealth Life. This is an album about Buffett, written by a close friend of Buffett. When it comes to Warren Buffett, the name is like tears. Whenever it comes to him, people seem to have endless topics. For example, he is the world's most well-known ancient god, who has been leveling in the investment circle for a lifetime, and eventually became the world's richest man. He led Berkshire Hathaway's stock price, which once reached as high as $260,000 a share. With a fortune of genius numbers, Buffett still maintains a simple life. The peach-flavored cola and beef burger is the richest man's favorite. Buffett has long said that he will leave a very small legacy to his children after the trend. The rest of the wealth is donated to charity. So, what exactly is the secret of Buffett's success? Why has he been able to maintain solid earnings for decades? Also, will Buffett, who is not interested in technology and the internet, be left behind in the booming digital age? How long can Buffett maintain such a high level of investment? These are all topics that everyone talks about. The Snowball book gives us a great perspective on how to observe and understand this legendary rich man. The author of this book is Ellis Schroeder. Schroeder's beginnings are not small. He once served as a managing director of the world-renowned investment bank Morgan Stanley. Because of his business relationships and industry circles, he and Buffett knew each other well and became very close friends. All your business dealings give Schroeder more opportunities to get up close and personal with Buffett. As Buffett's next friend, he was the first to suggest to Buffett that he should write a true biography to document Buffett's manager. Buffett took his advice and gave Schroeder enough trust, help and support in the process of writing this book, providing him with a lot of first-hand information and personal memories. If you're interested in Buffett and want to learn about his rich life, then this Snowball book will be a very good choice. This book is divided into upper and lower sides, and the content is very detailed, so this print will also be divided into two parts to tell you. Now we're going to tell you about the first half, and we'll focus on the three men who influenced Buffett's life. Buffett's father, Howard Buffett, Buffett's mentor, famous investor Graham, and Charlie Munger, a good partner in Buffett's career. So in the second half, I'll share with you three secrets to Buffett's rich life: blessed beings, fortune, and unthinkable concentration. The words Blessed Sutra and Fuli may sound a little unfamiliar, and I will explain these two concepts in detail for you when introducing the secrets of wealth. First, let's take a look at the three men who influenced Buffett's life. Let's start with Buffett's father, Howard Buffett. In order to distinguish these two Buffetts, when we tell the following story, we will collectively call Buffett's father Howard. Howard was a stockbroker by profession, but his greater interest was politics. Howard also served as a congressman in Washington for a time. But the political Howard also offended many people because of this, and did not have particularly high achievements in his career. In addition, as a stockbroker, Howard did not achieve much either. So Buffett is not rich. He did not accumulate wealth from his father. But Howard left Buffett a priceless fortune called the internal scorecard. What does the internal scorecard mean? Let's start by explaining his antonym, the external scorecard. This word is a little better understood. People are social animals, and when they do something, they will look at it from the perspective of others, and always pay attention to how the outside world sees themselves. This is a typical person in the form of an external scorecard. The internal scorecard is the opposite. A person never pays attention to how the outside world evaluates himself, but according to his own internal standards and forms of values, he is not influenced by external interference and authority. In this way, once the person who does things according to the internal scorecard, he is an independent thinker, assertive person. This valuable quality allows Buffett to think independently and rationally without external interference in his long investment career. It will not waver when it is a major financial role, and can still adhere to its own investment principles when the financial market is Eastern. To illustrate the importance of the internal scorecard to his investment career, Buffett uses a multiple-choice question. Would you rather be seen as the world's greatest investor but actually the world's worst investor, or would you rather be considered the world's most incompetent investor when in fact the best? Obviously, Buffett gave his answer with practical actions. In 1999, the internet was surging, and the explosive growth of the IT industry not only gave birth to many world-class rich people, but also immersed everyone in the crazy rising stock market. Buffett felt that at this time, it was inappropriate to criticize the internet industry. He believes that the products of these companies are too dependent on the future, and the value of the companies is in an uncertain future, so he is not optimistic about the IT industry. As soon as this remark came out, it triggered fierce criticism from market participants. These people said, Buffett is an excuse for missing the IT industry seal, can't eat grapes and can't say sour. And this year, Buffett's investment income is lower than every year, so everyone is waiting to see Buffett's jokes. This old man is finally about to retire from the stage of history. However, Buffett, who insisted on the internal scorecard and insisted on independent thinking, was unmoved, still insisted on his own judgment, and repeatedly reiterated his disapproval of the IT industry. Of course, everyone knows the story behind. Entering the new year before, the technology stock bubble burst, and most of the IT upstarts disappeared. Many investors went bankrupt, but Buffett and his Berkshire Hathaway survived. Buffett has experienced many stock market crashes in his decades-long investment career, but he has still been able to maintain excellent investment returns. This is inseparable from his ability to adhere to the internal scorecard at critical moments, not blindly obey, and trust his own judgment. Then you will surely ask, how can I have an internal scorecard? This is closely related to your experience and education in the same year. As a child, if your parents' focus was on how the whole world saw you, they ignored and obliterated your true thoughts. So no matter how you adjust it later, you will probably still use an external scorecard. Buffett is very fortunate to have a father who uses internal scorecards 100%. In the process of Buffett's growth, Howard taught deeply along the ship and cultivated Buffett's powerful internal scorecard. Buffett was impressed by the fact that he and his father once went to a baseball game. Generally, the competition trainees will introduce the well-known people in the audience. What about Huahuada, because of politics and intransigence, offended many people. So when he was introduced, he came together, and the audience was silent. Under such pressure, Buffett found his father standing there, without saying a word, calmly facing everything in front of him. So Buffett later lamented that his father was a real six, and he didn't care what others thought of him. Another important influence of Howard on Buffett was that he brought Buffett into the financial world when he was very young. When Buffett was a child, he went to his father's office whenever he had the opportunity, where he found himself very interested in the numbers of the financial market. He even hopes to figure out the patterns between the numbers. At the age of 7, Buffett began reading books on his father's bookshelf about bond investing. For his 10th birthday, Buffett wanted a trip to Wall Street. Huahuada not only took him to Wall Street, saw the New York Stock Exchange, but even took Buffett Jr. to Wall Street to visit the legendary CEO of Goldman Sachs Group Warren Buffett. In the meeting with the inside, the famous Wimberg did something that Buffett will never forget. As he prepares to leave the house to finish his visit, Wimberg kindly asks Buffett which stock you like best. Buffett has always been willing to limit his success to good luck. In fact, the most important thing is that he was born in a family with a good family environment, and he also received a good education. Buffett believes that his parents are his greatest wealth in the world, although he has never inherited any property from his parents. Okay, that's the end of Buffett's father. Let's take a look at the second man who had a major impact on Buffett's life, Benjamin Graham. When Buffett went to Columbia University, he was already a well-known businessman in the local area. At Columbia, he met a teacher who had led him on his path to professional investor, Graham. Graham was known as the godfather of Wall Street at the time and was a very veteran stock investor. He published The Smart Investor in 1949, which explained how the stock market works in a way that ordinary people could understand, showing how he used rational and mathematical methods to value stock genes. Before Graham, no one could tell exactly how the stock market worked, and investing was not systematic, more like gambling. Buffett's college roommate recalled saying that Buffett, betting on the Smart Investor Japan book, was as excited as finding God. In addition to learning from Graham the method of scientific and systematic analysis of the stock market, Buffett also learned two very important investment concepts, namely pickling and the art of asset allocation. So what does pickling mean? It is the small cigarette butt that is left at the end of the cigarette, also commonly known as the butt of the cigarette. It's such a thing. Pickling is one of Graham's most important investment philosophies. In Graham's view, cheap and unfavored stocks are like pickled ground thrown on the ground. These are all dirty garbage that others may see, but Graham is very good at finding these pickles, lighting them, and then sucking them up to the last bit of value. It sounds simple, but not everyone can easily find pickled land, because a large amount of pickled land is dirty garbage, and only a small amount of pickled land is worth investing in. To that end, Graham researched a whole set of ways to invest in pickling companies. One of the core key points is how to control the risk within a safe range. This key point is also very simple. Any company will have its own assets. Of course, there are liabilities. When sold after losing all assets and paying debts, if there is still left, then it is shareholders' equity, also called net assets. Graham's logic is that these companies, despite their downturn or even losses, are likely due to the external environment. Once the environment improves, stock prices rise. Then buying cheap stocks in the winter is a very cost-effective thing. And the worst outcome is that bankruptcy liquidation will not make a profit. Therefore, Graham's investment strategy is to look for stocks in the capital market that are depressed and unasked, and then look for salted companies with real company value and greater than the value of stocks from these stocks to invest. So here's the problem. The most important part of the seemingly simple and clear investment logic is that the actual value of the pickled company worth investing in must be greater than the value of the stock you buy. So how to assess the true value of the company, control the risk within a controllable range, and leave enough room for error? This is the core of salted land investment. To that end, Graham explored a whole range of ways to assess a company's true value. He constantly educates his students in the classroom. When researching a company, think of yourself as a detective, discover the true value and debts hidden in a lot of details, and think about why the company can and why it cannot. Graham's students know that stocks are not cold price numbers and flat prices, and that their value can be broken down into many different parts that need to be evaluated separately. In addition, Graham gave his students a very important reminder: invest safely. In addition to considering that the net worth is greater than the cost at the time of entry, there is also enough room for error. It is quite possible that an analyst's analysis of the value of a stock is correct, and the stock is indeed undervalued, but the market is complex. The value price of a stock may be significantly lower than its actual value for a long period of time. And over time, the company's net worth may continue to decrease. So, even if the investment is a steady profit when you start, it is likely that you will be deeply trapped in it over time. Therefore, investing in a strict company, in addition to estimating the true value of the company like a detective, also needs to leave enough room for error. During the time of learning and investing with Graham, Buffett received systematic training to become a first-class professional investor, and he mastered the essence of Graham's rigorous investment and successfully operated events in the market. In Buffett's early investment years, most of the company's stocks were cheap, and he bent down to beat the stocks together like a stooped and unattended land. And over time, these strict lands have brought Buffett great wealth in the future. After the United States entered the crisis in 2008, the 78-year-old Buffett seemed to have returned to decades ago, carefully searching for the rigors that met his requirements in the changing stock market. Graham also taught Buffett another peerless martial art, the art of asset allocation, to put money where you can get the highest return. So how to do it? Graham's method is to buy money from one business to another business that is more profitable, so that it is not affected by the investment cycle and can always find profitable cows. For example, Graham invested in a coal mining company, and the coal mining industry was already in decline at that time, and the company was sure to decay in the future. But it now has a good cash reserve, so Graham used that cash to buy a growing business. Then you can easily guess that the coal mining company eventually failed, but Graham's company became a big bull stock in the consumer market. Buffett learned from here that businesses need to be diversified, which also opened the way to building the future famous Berkshire Hathaway company. When Buffett first bought Berkshire Hathaway, he was a textile factory, a traditional industry in the mountains of Hiroshima. In the years since, Buffett has continued to inject new money-making assets into him, and he has become a super investment empire with stocks and bonds and a lot of cash. He owns several insurance companies covering the entire insurance industry, and he owns shares in many high-quality companies, including American Express, the Coca-Cola Company, FedEx, Washington Post, Candy Company, etc. There's no way you can classify Berkshire Hathaway into any one type of company. Some people joke that Microsoft has become a Fortune 500 company by producing software, and Coca-Cola has become a Fortune 500 company by relying on Michaela. What about Berkshire Hathaway, who became the world's best-known company with money from production? Someone has calculated that if you had invested $10,000 in Buffett when Berkshire Hathaway was founded, you would have earned more than $200 million in after-tax income today. Berkshire Hathaway's stock, after decades of fee growth, has grown from less than $10 when Buffett started to $260,000 a share today, and it is estimated that it is no surprise in the global capital market. Well, the above tells you about the two men who influenced Buffett, Buffett's father and Graham. Below, let's take a look at the third man who influenced Buffett's abyss, the famous Charlie Munger. Charlie Munger is Buffett's good partner for many years, and it can be said that the two of them worked together to build the Berkshire Hathaway empire, creating the best investment record ever. In the eyes of many Buffett fans, sometimes it is often felt that it is not clear to distinguish between Buffett and Munger, because they are too similar. Buffett and Munger are both silver handles, even combing their hair in exactly the same way, they walk not the same clumsy, and their bodies are tilted in the same direction. Both of them wore a gray suit all year round, and they didn't look very trimmed. Both of them wore similar old-fashioned glasses, but both had the same direct and intelligent gaze. Not only are they similar in appearance, but they also think in a similar way and invest in strategies. As for the later time when Munger was reviewed, he was even asked by the relevant departments whether you were Buffett's alter ego. Faced with this kind of abusive joke question, Munger's answer is also very personal. He first admitted that he and Buffett have some similarities in behavior patterns and ways of speaking, however, he also said that he would never be a stabbing and burning man, and he had his own range of activities. Indeed, in the long working career of Buffett and Munger, both of them have influenced each other and absorbed each other's constants. The two had known each other since they met at a friend's lunch in 1959, and the lively conversation has continued for 60 years since then. Their friendship is also a blessing in entering the world. Although in the eyes of outsiders, Buffett is more famous, but Munger has many fans. Munger brought many new investment ideas to Buffett and helped Buffett refine his investment philosophy. For example, Buffett often mentioned Munger's theory of shoe buckles, and said that this theory gave him a deep inspiration. The so-called shoe buckles are the metal buttons on old-fashioned leather shoes in the past, and the gadgets that can fix the laces. The shoe buckle theory came from the father of a classmate of Munger, who had a friend who planned to hoard in the shoe buckle market. Because the shoe buckle market is very small, this person ends up occupying the entire shoe buckle market, so that he can study on his own. Monopolizing the shoe buckle market made him feel good, and he considered himself an expert in all aspects, and he was very aggressive and promiscuous in everything. Munger believes that this approach is profoundly wrong. Munger is also a good teacher, he loves walks, but he is always cautious about areas he is not familiar with, never speaks out in these areas, and can always remind himself not to fall victim to shoe buckles. When it comes to the impact of Munger's shoe buckle theory, Buffett has also set himself a range of capabilities. He concluded that he could only do 3 things within his ability. The first thing is money, the second thing is investing, and the third thing is your own life. In addition, Buffett is neither interested nor casual. This is very prominent in Buffett's investment strategy. That is, Buffett is resolute in areas he is not familiar with. Even in the face of a strong recommendation from his long-term friend Microsoft founder Bill Gates to buy Microsoft stock, Buffett still chose to refuse. Because he himself, first of all, does not understand the IT industry, and the second is not interested in understanding it. In addition, Munger also injected a lot of new ideas into Buffett's investment philosophy, perfecting Buffett's investment philosophy. For example, let Buffett rethink his investment strategy. In the early stages of Buffett's investment career, he followed Graham's flooding principle and bought very cheap stocks. Graham's investment approach is essentially a quantitative analysis of each stock. Although it is a stupid method, as long as the rational execution controls the risk within the safe range, the investment is always urgent. Buying is to sell. Absolutely do not covet the principal, you can guarantee to make money. Buffett completed the original accumulation of funds by investing in flooded companies. But Buffett doesn't realize that Graham's theory of flooding has a fatal flaw. Graham was an investor who lived through the Great Depression of 1929, and his investment theory was inevitably pessimistic. Always on alert to financial disasters. As a result of this pessimism, Graham's investments have always been stuck in the bitter wood market where he stooped down and took the last sip, making hard money. This theory works very well when the economy is 1 meter lower and the capital market is immature, because there are many stocks in the market that are undervalued. However, as the economy improves, more and more people enter the stock market, so that the overall stock price will be pushed up, and there will be fewer and fewer cheap stocks. Moreover, an overheated market will trigger the price of junk stocks to be hyped, and an irrational market is not suitable for the logic of salted investment. But Buffett still hasn't given up salted investment. After all, he once made money through this investment, and people's habits are not easy to change. Even Buffett is no exception. Influenced by Buffett, Munger is also adopting the principle of salting to find good investment opportunities. But Munger's search criteria are different, and he likes to do big business. Munger is not satisfied that Buffett only looks at the company's assets and liabilities to examine the company. He believes that these studies only reflect part of the company's problems, and he focuses more on the company's intangible assets. For example, his management level, brand persistence, business model, industry prospects, etc. At the same time, Buffett's salting investment has also met with calm. On the one hand, the stock market is booming, and cheap pickled companies are hard to find. Buffett, on the other hand, was already a millionaire by this time. His partner firm can mobilize tens of millions of dollars. He is no longer a retail investor on the stock market. What Buffett needs to think about is how to find the right investment channels for such a large amount of money. Spending money on a stern company that is already overvalued is certainly a very unwise thing to do. That Munger's investment strategy opened up Buffett's ideas and made Buffett re-examine his investment strategy. Buffett later concluded that buying a good company at a reasonable price is far better than buying a reasonable company at a good price. That is to say, buy a company with a perfect management system at an expensive price. The company has a good reputation and has luck. It is far more cost-effective than buying a company that is flawed in every way at a cheap price. In addition, Buffett also said that a good investment is to find a dependent business with dependent management. Munger understood this early on, and he was a slow learner. So after that, Buffett began to gradually move away from the first stage of his investment career, which was to buy stocks that could only be cheap with only possible little money. Abandon the short-term speculative strategy of buying in order to sell. He began to mature his investment career, focusing more on the company's business model, future development, management level, and other more abstract issues. Only good companies can enter Buffett's speech. From this time on, Buffett began to gradually form a value investment strategy for long-term investments. Our career, hello and welcome back. We go on to unravel Snowball, Buffett and his life of wealth. In the first half of the audio, I tell you the stories of 3 men who influenced Dr. Buffett. The 3 men are, Buffett's father, Howard Buffett, Buffett's mentor, the famous investor Graham, and Buffett's good partner Charlie Munger. Through their stories, we can learn about Buffett's growth and the trajectory of his investment philosophy. So Buffett, as the world's top stock investor, especially in the unpredictable stock market, can maintain the ultra-high returns for decades. He must have many secrets to success. So in this section, I will continue to share for you the 3 wealth secrets of Buffett's success: floating, wealth and super focus. First of all, let me introduce you to floating deposits. Float is floating float, deposit amount of gold. The so-called floating deposit, that is, to put it bluntly, is the money that is collected in advance and then paid. So, you will understand at once that as soon as this money comes in and out, there is a time difference in between. So wouldn't it be very appropriate to take advantage of this time difference and invest this money? Yes, there is indeed someone who has been doing this for so many years, and that person is Buffett. His insurance company is constantly sending a large amount of floating money for Buffett, and it has been for many years. In fact, many industries also have floating deposits, such as we are all familiar with, leaving hair shops, restaurants, and suggestion rooms, always hoping that customers can lose a card, and then deposit some fees, and then you can spend by card. But these floats in the retail and consumer sectors are a small amount compared to floats in the insurance industry. The floating deposit in the insurance industry has a natural huge advantage: the consumption of insurance is generally very high, and everyone's premium is not a small amount. Second, although the fee is charged in advance, these customers will soon come to spend, and the money cannot be on the account for a long time, but the premium is completely different. From the time the premium is collected to the time it is paid, sometimes it can take decades, or even no payment at all. Friends who have bought insurance know that most people who buy insurance lose money and use their cash to buy a protection. In the vast majority of cases, these premiums provide a huge cash flow for insurers. The amount is high, the use cycle plant is low and the cost is low. Since float has so many advantages, why don't others use float investment like Buffett? The reason is simple: Buffett started very early. In the 50s, when many people were not sure what insurance was, Buffett began to study how to use insurance float to invest, and he had a lot of money to buy cheap stocks. So how did Buffett do it? Thus, back to Buffett's fall school at Columbia University, it was almost the 50s of the last century. Buffett stumbled upon the fact that his teacher, Gray's mother, was the chairman of a business he had never heard of, in addition to investing in stocks. Buffett, who studied with questions, went to this company to find out for himself. It was during this visit that he learned that the company was a well-known auto insurance business at the time. Unlike traditional auto insurance companies that rely on insurance brokers to sell insurance business, this company uses mail-order marketing to travel insurance products to the target customer's office or home, so the cost naturally drops greatly. Then you may ask. The cost is down, but there is no insurance broker to check those drunkards, people who often speed and receive marketing emails to buy insurance, then this company is not very bad? They have long thought of this. To try to target customers that insurers don't want to meet, they sell auto insurance only to government employees. We all know that government employees are very law-abiding. Not only do they not drink and drive, they do not exceed the speed limit. Their caution will also reduce the risk rate, which is equivalent to reducing the cost of the company in disguise. So less than 48 hours after Buffett returned to Columbia, he immediately sold 3/4 of his portfolio, using all the money he cashed out to buy shares in the insurance company. Buffett began recommending the stock and predicted that it would double in price in 5 years. But unfortunately, many people do not understand the power of the insurance industry as deeply as Buffett, and they laugh at Buffett, which is simply cannibalistic. At the time, most people didn't understand insurance, and complicated actuarial calculations seemed more like odds in a casino to outsiders. Buffett accidentally entered the insurance industry by dealing with this company. At one point, Buffett even wanted to become an actuary after graduation. However, with the continuous understanding of the insurance industry, especially when he discovered the larger secret of insurance deposits, Buffett found that he was willing to do something for the rest of his life and make money. Buffett knows that insurance companies are not charitable organizations, and he must make a profit. After collecting huge premiums, the biggest problem for insurance companies is how to make money with money, and making money is exactly what Buffett is most interested in. What's more, insurance company floats are simply free money in Buffett's view. From collection to payment, the middle is built for decades, and there is no need to pay interest. What could be more perfect than such a transaction? It is no exaggeration to say that Berkshire Hathaway, which is in full swing today, is essentially an insurance empire. He has included all kinds of insurance business, including insurance, property insurance, health insurance and has also brought Buffett a steady stream of cash ammunition. Being able to buy valuable companies and stocks in the capital markets has allowed Buffett's wealth to grow exponentially. Of course, in addition to insurance, Buffett is also searching for other companies that can obtain stable deposits. Blue Chip Printing Company is another floating gold vault for Buffett. This company also has a special meaning for Buffett. This is the first time he and his good friend Munger have teamed up. In the 60s, Munger recommended a company called Blue Chip Printing to Buffett. The main business of this company is the issuance of gift certificates. At that time, merchants in the United States were very popular to use various gift certificates to attract customers for promotion. In the beginning, merchants issued their own gift certificates. But later, as such promotions became more and more popular with customers, there were some companies that began to specialize in gift certificates. Blue Chip Printing was one of the largest gift voucher companies at the time. But by the time Buffett and Munger paid attention to the company, the gift voucher market was no longer in gold. Blue chip prints are also in a recession in business. But after discussing with Munger, Buffett still decided to buy blue chip prints. The first reason is that blue chip prints have a lot of support money. Merchants pay blue chip stamps large amounts of cash to buy printed gift certificates. Until consumers come to redeem these gift certificates, the cash crawls on the blue chip stamped account. So blue chip prints accumulate a lot of cash. But because of management's conservativeness, the cash was not put to good use. On the other hand, the gift voucher market is shrinking, and blue chip print prices are also depressed. This gives Buffett a super good opportunity. So, Buffett and Munger, two good friends, hit it off and teamed up to win the blue chip print. From the first day he won the blue chip print, Buffett began helping the gift certificate company transform. He used his floating money on his blue chip stamp account to buy a series of quality companies that paid off handsomely. Fukumura has made Buffett's investment empire, but there are two sides to everything. Now the huge amount of Fukumura gold has also brought new troubles to Buffett. The latest news shows that Berkshire Hathaway has nearly $100 billion in cash on his books. For ordinary people, it is really a blessing to have so much cash on the bank account. But for Buffett, that money lying on the books means waste, a huge waste. But Buffett has a hard time finding suitable investment targets in the market. The capital market has been nurtured very maturely, there are investors everywhere, and there are many investors. So it's hard for Buffett to buy them in the beginning, when stocks were cheap. For Buffett, the $100 billion in cash lying on his books is a new challenge in his investment career. He may need to find new ways to invest to solve this big problem. Well, that's what says Buffett's first wealth secret, floating deposit. Here's an introduction to Buffett's second wealth secret, negative profit. The repeated profit of negative interest rate is what we commonly call profit rollover. The principal and interest earned from the previous investment are used as the principal of the next investment. So at the beginning of each investment or continuation cycle, the principal is constantly increasing. The negative profit thing actually has a very miraculous cumulative effect. Friends who have understood the negative interest formula may find that there is a huge mathematical amplification effect hidden in the calculation formula of negative interest. Although it only increases the interest part by a small amount each time, it does not seem to increase the return on investment much. But over time, that number will be quite staggering. To give you a simple example, let's say a person who deposits $10,000 at the age of 20 and maintains an average annual growth rate of 20%. Each year, the proceeds are put into the next year's investment. So by the age of 80, how much money will be the last benefit of this person, can you imagine? It's $600 million. Of course, we all know the power of negative profit today. But in the early 40s, when Buffett was 10 years old, he already understood this truth. At that time, 10-year-old Buffett found a book in the library called 1,000 Ways to Make $1,000. In this book, which looks like chicken soup success, Buffett first learned the concept of negative profit. The book tells Buffett that he needs to make $1,000 and start with that, as long as it maintains a certain growth rate. Every year, if the income is continuously invested, a qualitative leap will occur. Buffett, who was only 10 years old, was deeply touched, as if he saw the steel rod in his pocket turning into dollar bills one by one. He announced that he would be a millionaire at the age of 35. But in 1941, the whole world was under fire from World War II, and the U.S. economy was in recession, and no one would take the words of a 10-year-old child seriously. But Buffett himself doesn't think so. He understands the power of negative profit, and he has 25 years to go until he is 35, which is enough for him to fulfill his millionaire dream. The advantage of Buffett is that he is not a person who just says and does nothing. He makes a millionaire vow. Buffett begins to work hard towards this goal. He tries to make money by all means. By the time he was 14, Buffett had amassed the $1,000 he needed to get started. Since then, Buffett has been using negative investing, which is to invest every money he earns into his business. In fact, the coin-operated pinball business is a typical Buffett is a negative investment. High school student Warren Buffett invested $25 to buy a second-hand Velchin brand pinball machine, and he was able to run to his nearby Richmond shop and tell the owner that he was a representative of Velchin Pinco Company and was appointed by the company to talk to Richmond shop. RISBR shop does not take any risks, does not need to pay any cost, just vacate a very small space, put a pinch, and you can get half of the benefits brought by the pin box. When the owner of the Lefa shop heard it, it was quite cost-effective. On the one hand, it could charge additional income from the pinball machine. On the other hand, the pinball machine would also bring more customer flow. As a result, Buffett's first pachinko investment was sold. A week later, Buffett received back the $25 he had invested. What he did immediately was to buy a second pinball with the $25 he earned as described in the book 1000 Tricks to Make $1,000, that is, to put the proceeds into the next investment to make a negative investment. As his income increased, Buffett continued to buy pinballs and spread them to more lip salons. At the same time, he also subscribed to publications that published information on second-hand pinball machines, followed the development of the pinball market at any time, saw cheap second-hand pinball machines, and decisively took them. As a result, the business grew bigger and bigger, so that by Buffett's high school, everyone knew about his pinball business, and his classmates wanted to join the gang, like chasing sought-after stocks. At this time, Buffett really experienced the magic of negative profit, and he was like an engine, driving money to work for his mood. For more than half a century, Buffett practiced negative investing. When Buffett, who is worth more than $36 billion and has become the world's second richest man who is kind to Bill Gates, he answers the question about what the ideal business looks like. The ideal enterprise is an enterprise with high capital returns, which can use a large amount of capital to achieve high returns, and can become a company that can become a Valori machine, so that it can achieve capital turnover through these enterprises and acquire more Valberry enterprises. From high school, pinball machine to the world's rich list, you will find that Buffett's investment strategy has not changed in his investment career of more than half a century. That is, he constantly obtains investment capital from rich village managers, and finds suitable investment changes through research and evaluation. Then bet on the investment, and after that let Valberry play a role in driving the geometric growth of wealth. Of course, Buffett also pointed out that there are two basic principles that need to be remembered forever when making Valberry investments. The first principle is, do not lose the principle. The second principle is to remember the first one. Buffett uses a very humorous way to say the core of Valberry investing. The key to Valberry investment is not how high the yield is, but not to lose the principal. A year's loss needs to be made up with higher returns in later time, so you have to take greater risks, which is not worth the loss. Buffett likes to use a metaphor to summarize the secret of his success. He said that life is like a snowball, and the most important thing is to find very wet blood and a long slope. When Buffett talks about wet blood, he refers to the principle of the investment. This part, he has solved through the rich deposit. So what about Foley, who helped Buffett find a long slope? Note that Buffett is talking about a long slope here, and very wet blood has to slide down a long, gentle descent slope to become a big snowball, rather than rolling down a very steep slope. It's easy to fall to pieces. Well, the above introduces you to rich deposit plus Foley, which are two wealth secrets that Buffett has been insisting on for many years. Buffett's investment strategy is actually an open secret of the capital market and an investment rule that everyone knows. So why hasn't there been a second bloomer in the capital markets for so many years? Why can't anyone achieve the same brilliant investment results as Buffett? In fact, everyone in the capital markets wants to be the next Buffett. They buy insurance companies, get rich deposits, and then look for investment projects and make Valberry investments, which is literally building their own company according to Berkshire Hathaway's model. But so far, no one has been able to surpass Buffett's performance. Why? Many trusts want to emulate Buffett's approach and portfolio, and their approach does look a lot like Berkshire Hathaway, but in reality, it is not. Why not? Behind Buffett's seemingly effortless achievements, there is a lot of unknown work that requires decades of consistent concentration to complete, which is the key to Buffett's success. Next, I'll ask you to share Buffett's third wealth secret: focus. When Buffett answers the question of what the most important quality in life is, his answer is focus. Buffett's focus is not something that ordinary people can do, and even his achievement is deeply admired. Buffett, he said, is simply a focused learning machine. If we dissect Buffett's concentration, we will find that he is not actually focused on any difficult things. Buffett's focus is on doing simple and stupid things for decades. In 2004, the 74-year-old Buffett took over a thick book from The Economic Man with a detailed list of South Korean stocks. Buffett has been studying the global economy, hoping to find overlooked and undervalued countries and markets, and find good companies worth investing in, so this time he targeted South Korea. After determining the goal, Buffett began to flip through this big difference book one by one, page by page, every number on every page he will not let go. Because South Korea's corporate accounting rules are different from those of the United States, in order not to be easily confused by these numbers, Buffett began to study Korean accounting standards. Can you think about what the richest man in the world is doing? In fact, this is nothing more than Buffett's most ordinary work in more than half a century. He leaves every morning from the house where he has lived for most of his life and arrives at the office at 8:30 a.m. This office has been used for most of his life, and Buffett has begun to focus on his work. He first reads the reports of the major media outlets, and then the various reports and data that Boxer Hassa passes on to his company, from how many car insurance policies he has sold to how many orders for prison guards' uniforms he has received. Buffett has an amazing memory, he can remember a lot of numbers. Then Buffett began to delve into reports on hundreds of companies he hadn't bought, as well as learning about overseas markets he thought were worth investing in. When necessary, Buffett personally visits these companies and encourages face-to-face conversations with their managers. But this is not the usual practice for financial investors. Most investors like to sit in their office and read someone else's report. Buffett, like a detective who pays attention to all the details, not only reads first-hand information about hundreds of companies, and he would go to the stock exchange to get more information about the companies involved, and even go to the library and find newspapers from decades ago to get more information to study these companies. It's like when he studied with Grader's evil mother, Buffett would search for everything about him. It was accidentally discovered that Grader's evil mother never disclosed that he was the chairman of a company. This incident piqued Buffett's curiosity, and he personally visited the company and then entered the insurance industry. Buffett answered this when explaining why he was able to focus on these details for decades and invest in such a stupid way. For me, he said, it's like meeting a girl, you have to know everything about her. To illustrate, for example, how well Buffett knows. Tax returns are also materials that Buffett carefully studied. In the process of researching, he discovered that there was a problem with the tax return of a well-known child welfare agency in his city. So, he took out the footage of studying the financial reports of listed companies and found that this welfare organization was very bad and abused donations. Buffett exposed the matter through the media, and the report also won the Pulitzer Prize for Journalism, the most influential journalism award in the United States that year. And another Pulitzer Prize-winning piece for this news sharing was the Watergate story by the Washington Post, which exposed the Nixon campaign scandal. It is enough to prove how important Buffett's discovery is. However, in addition to being very angry that these people misuse the funds, he is more distressed that the money is piled up there at random without reasonable use, not even a budget. Buffett believes that not being able to use money to make money is also a sin. If there's one other entertainment in the world that distracts Buffett, it's playing bridge. This is almost Buffett's biggest hobby outside of investing. He even joked that if 3 people in a prison room could play bridge, he wouldn't mind going to jail forever. Buffett's interest in bridge is as focused as his attention to financial markets. Because of his focus on playing bridge, Buffett almost became the champion of the world bridge competition. In order to become a professional bridge player, Buffett studied with world champion Ms. Osberg. At Osberg's suggestion, Buffett even agreed to have a computer in his study so he could play bridge for hours every day after dinner. You know, even Bill Gates didn't succeed in getting Buffett to use a computer. Bill Gates once struggled to convince Buffett to use a computer. Bill Gates said computers allow Buffett to keep an eye on his company's stock price movements. Buffett's answer is, I don't want to see the results in 5 minutes. What's more, I know better about stock price movements than anyone. Bill Gates isn't dead yet, he said, he's going to send Microsoft's prettiest sales lady to call Buffett a computer. As a result, Buffett's answer is even cooler, you offer a condition that you can't refuse, but I will still refuse. But for bridge, Buffett chose to start with. Not only did he play bridge on his computer at least 12 hours a week, he also gave himself a screen name called Reminder Unit. So Buffett's fascination with bridge has reached the point of being obsessed. In order to be able to compete with Osberg and several netizens, he advanced the fixed dinner time for many years. And playing bridge, nothing can distract him. For example, once, a bat flew into his house and was rampaging through the room. As a result, Buffett is still sitting in front of the computer, staring at the computer screen and playing bridge, and his eyes are not willing to leave. Oh, it's okay, he won't play my bridge game. Since the guidance of a champion-level teacher, Buffett has improved rapidly, and he is no longer satisfied with playing cards with people on the internet, but hopes to compete with higher-level players. So, Osberg took Buffett to sign up for the World Bridge Neck-Marking Competition, the top event of bridge. They participated in the mixed doubles competition, which was very influential and had a lot of competitors. However, when Buffett appeared in the arena, many people recognized him and became a focal point in the arena. Osberg's psychological expectation is to receive some actual combat experience and gain points for Buffett through real games. As a result, Buffett came hard, although he said that his level was not as good as that of professional players, but he showed extraordinary concentration. As soon as I went to the table, I couldn't feel the many crowds watching me play cards. When playing, Buffett responded calmly, his psychological quality was particularly good, and he fully played the level of playing cards at home, and he can always keep an eye on the movements of his partner Osberg, and the two cooperate tacitly. In the end, Buffett's focus made up for his lack of professionalism, and he and his partner actually reached the final. At this time, Buffett suddenly chose to withdraw from the competition, and the reason for the withdrawal was that he got the news and was about to talk about an investment. At this time, we finally found that the familiar Buffett who was in love was back. Well, speaking of which, the content of this book is almost the same, let's briefly summarize and review. In the first half of the Snowball, I introduce you to the 3 men who influenced legendary investor Warren Buffett. The first is Buffett's father, Howard. Howard led Buffett into the financial world and gave Buffett the environment to grow up as a good investor, especially on a spiritual level. Howard did not pay attention to how the outside world evaluates his children, as many parents do, but taught Buffett to be an independent-minded, assertive person who respects his inner thoughts. The internal scorecard is the most important asset of Buffett's investing career. The second person who had a profound influence on Buffett was his teacher, Graham. At Graham's side, Buffett received systematic training to be a first-class investor. He developed a way of identifying investment opportunities based on a wealth of first-hand information. This clumsy approach has benefited Buffett for life. Graham's forward-thinking investment philosophy has made Buffett an advanced market investor early in his career. The third place is Buffett's good partner Charlie Munger. The two of them are like a husband and wife for many years, not only more and more like thinking about investment, but also reaching a high degree of tacit understanding. These collaborations have helped them become one of the most successful investment partners in history. Although Buffett's fame is much greater than Munger's from the outside world, first-class investor Munger perfected Buffett's investment philosophy. Is an integral factor in Buffett's success. Being able to have a good friend who shares the same interests is also a valuable asset on Buffett's investment path. And in the second half of the Snowball book, I introduce you to Buffett's 3 wealth secrets: serving, negative profit, and focus. Buffett began to understand the insurance industry early on and discovered the great value of deposits. These free-to-use funds have helped Buffett have ample ammunition in the capital markets, which is the cornerstone of Buffett's success. The second sensitive basis is negative profit, that is, profit rollover. 10-year-old Buffett understands the value of negative profit. What's more, he was able to move quickly, looking for every possible opportunity to make negative profits work. Like the metaphor that Buffett likes to use, life is like a snowball, the most important thing is to find very wet blood and a long slope. Negative investment is a long slope in which wealth can grow exponentially. The third sensitivity, focus, is the most important factor that distinguishes Buffett from other investors. Buffett, who was in Gui's year, still maintains the focus of his youth. He can learn Korean accounting standards from scratch and understand the Korean stock investment market. Even though he has become one of the richest people in the world, Buffett still personally visits those he thinks have enough potential. But the unknown small company and the founder shareholders talk face-to-face to get first-hand information. Such a dedication is something that those who want to succeed by imitating Buffett's investment strategy cannot do. Well, the story of Buffett's wealth is shared here for you. Congratulations, after listening to that book again. Thank you all for your support and attention. Subscribe to Tim Booker channel, like and share this valuable knowledge with your friends. Together, let's combine wisdom with practice to achieve our financial goals and create a better future. Thank you all and goodbye.